Shelby, for having me here today. Thank you, members of the committee. I'm someone who believes deeply in free markets, but I'm here today to talk about a market that is not working, at least not working for millions of Americans who find themselves on the wrong end of a credit card deal. Quite simply, the credit card market is broken. The basics of a credit card are pretty simple. Pay by plastic, get a bill, pay the bill. So why, as Senator Dodd notes, has the average credit card agreement gone from about a page long in 1980 to more than 30 pages long today? The answer is that these new pages reflect a business model that has changed from its earlier simple roots. Card companies still make money like they always did, with merchant fees and annual fees, a tidy $11 billion last year. Not bad. But they make their big-time profits from interest and penalties, an astonishing $79 billion from people who are paying minimum payments over time. Today's successful credit card company puts its product in the hands of as many shoppers as possible, pulling in decent profits on each one, but always hoping for the sweet spot, the customer who stumbles but doesn't quite collapse. That's the customer who misses a deadline or misses a payment or goes over limit and ends up paying 29% interest, $39 late fees, $49 over limit fees, and anything else that the credit card company wants to pile on. Credit card contracts have grown to 30-plus pages to make room for tricks and traps that will ensnare anyone who gets into even a modest financial problem. After years of on-time payments, a single stumble can create a cascade of credit defaults and trap a customer for years, even a lifetime, as Senator Casey noted, in a cycle of payments that will never pay off these debts. Some people don't worry about credit card tricks and traps. About half of all American families pay off their credit cards in full every month. And they rarely notice things like the mysterious fees for charges when it takes 9 days for a credit card payment to make it across country. Others enter the credit card market as a gladiator once entered battle, looking for leverage in the zero interest and grace period floats, and taking pride in their ability to carry a credit balance while dancing around the ever-present traps. But for 51 million American families who are juggling mortgages and car payments and health insurance bills and grocery bills, the credit card companies are imposing a huge tax. And for the 23 million of those Americans who are making only the minimum monthly payments, and sometimes not that, the tricks and traps keep them on the financial ropes, collectively shelling out billions to the credit card companies and never quite getting back on their feet. This, Senators, is where the market breaks down. In a perfectly competitive market, both firms and consumers would be given the information they need to make sound economic decisions. Given the complexity of today's credit card terms, 30 pages of incomprehensible text is not the same as understanding the terms of your credit card, especially now that the credit card companies routinely reserve the right to change the terms of your credit card on 15 days' notice with another incomprehensible insert into your bill. Sorting out safe cards and dangerous cards is almost impossible. As one industry expert just explained last month, bank products are, quote, too complex for the average consumer to understand. Senators, I think it's clear card agreements are not designed to be understood. Be clear, this is not about risk-based pricing. A risk-based pricing model is about the lender's assessment of the likelihood of repayment at the inception of the loan with subsequent calibration as more information comes due. Anyone who has a small child, as Senator Menendez noted, or a dog, or a deceased relative, knows that the initial pre-approved credit card solicitation is not risk-based. Instead, the model is based on putting as many credit cards into the hands of as many human beings, and dogs if they'll take them, and then when any of them stumble, trip, make the slightest misstep, load them up with tricks and traps and maximize profits at that point. Charges for late fees or over-limit fees reflect the price the credit card company thinks that it can charge and not have the customer cancel the card. That's what it's calibrated to, not to risk assessment. These tricks and traps are profit-taking, pure and simple, nothing more. One of the few bits of protection for consumers was eroded with the change in the bankruptcy laws in 2005. Prior to that time, any customer who was facing outrageous interest charges or penalty fees at least could credibly threaten to file bankruptcy and try to initiate a negotiation. This threat had the effect of curtailing at least some of the most aggressive practices. With the change in bankruptcy laws, however, many consumers no longer see bankruptcy as an option. Whether they are right or wrong doesn't matter. What matters is that even though they remain eligible for bankruptcy, some now listen to debt collectors who bully them and tell them that bankruptcy has become illegal. Others are discouraged by the increases in fees that make it more expensive for the poorest Americans to file for bankruptcy. As a result, lenders can sweat them for payments longer, keeping them trapped in a monthly cycle that these customers can never pay off. After the new bankruptcy law went into effect, a market that was already broken got a lot worse for families in trouble. Safer cards can turn a handsome profit, but because they give up the mega-dollar sweet spot created by the tricks and the traps, they will not produce the bloated profits of dangerous cards. If more people turned away from such cards, the market would quickly sort itself out. But if the consumer can't tell a safe card from a dangerous one, then the marketplace will not reward safe cards. Consumers bear terrible risks today when they use their credit cards. Some will do okay, but some will get trapped. It doesn't have to be that way. No one has to be an engineer to buy a toaster in America. No one has to be a crash test expert to buy a car. These are markets that have soared with innovation over past decades, but they've also been supported by national safety standards that kept burst into flames toasters and crumple on impact cars out of the marketplace. Government and industry joined forces to develop meaningful guidelines in other industries. Cheap shortcuts that would boost profits but leave consumers at risk have been banned from those markets, with the result that competition has intensified for the things consumers can readily see, like price and convenience and color. And consumers, most importantly, have safer products at lower prices. It's time for safety regulation in credit cards as well. There are 51 million American families who need your help, Senators, and they don't have much longer to wait. Thank you.
Thank you for your testimony.